Welcome to the FIC video on risk assessment. Mainly focusing on the guidance on risk assessments and ML, or TF or PF indicators. This document avails sectoral guidance on conducting risk assessments and indicators of common money laundering, ML, terrorism financing, TF, and proliferation financing, PF, activities. This guidance note is issued in terms of Section 9(1)(h) of the Financial Intelligence Act, 2012, the FIA. To help mitigate ML or TF or PF risks, the Financial Intelligence Center, FIC, issues this guidance to help institutions implement and enhance their internal anti-money laundering, combating the financing of terrorism and proliferation, AML or CFT or CPF, measures. Here are the steps to the guidance on risk assessments and ML or TF or PF indicators. You simply go to www.fic.na and it will lead you straight to the FIC homepage. On the home page you go to Publication, Guidance Note, select 2023 Guidance Note and you will see series of PDF file which are, Guidance Note 16 of 2023 Risk Assessment for Lending Institutions. Guidance Note 14 of 2023 Risk Assessment for Legal Practitioners. Guidance Note 10 of 2023 Risk Assessment for VASPs. Guidance Note 08 of 2023 Risk Assessment for DPMS. Guidance Note 05 of 2023 Risk Assessment for TCSPs. Guidance Note 03 of 2023 Risk Assessment for Real Estate Agents. Let us define money laundering. Money laundering involves disguising financial assets so they can be used without detection of the illegal activity that produced them. Looking at the risk assessment money laundering process, which is A. Placement. Placement involves placing the proceeds of crime in the financial system. For example, a business obtains a loan and then uses proceeds of crime, e.g. from its shareholders, directors, associates etc., to repay such a loan. B. Layering. Layering involves converting the proceeds of crime into another form and creating complex layers of financial transactions to disguise the audit trail and the source and ownership of funds. The aim is usually to create as much distance as possible between the illicit activity/criminal and the illegal proceeds. For example, assets or properties bought with proceeds of crime are later sold and proceeds from such sale are presented or used as if such are from legitimate origins. The loans which were initially legally obtained could have been invested in properties or other financial assets, for example. Such investments would now appear legitimate as the source of funds could be cited as loans. C. Integration. Integration, usually the last stage of the ML process. Integration is at times like, or part of the layering process. The aim is to place the laundered proceeds back in the financial system under a veil of legitimacy. The example given in B above includes a combination of both layering and integration when assets are bought with legitimate loans and the loan is settled with proceeds from illicit activities. Institutions, as part of their risk assessment process, should assess the ML or TF or PF vulnerabilities and high-risk factors associated with each of their clients applying for or having received loans or mortgage from same. The risk assessment section herein avails indicators of potential high risks. Money laundering vulnerabilities in institutions. Institutions are vulnerable to various financial crimes that can threaten the integrity of the financial system. Financial crimes are illicit activities that involve the use of financial systems to launder money or finance criminal activities. Mainly being, 1. Money laundering, ML, is the process of disguising the proceeds of criminal activity as legitimate funds. 2. Fraudulent loan applications. Fraudulent loan applications occur when a borrower provides false information to obtain a loan. 3. Insider fraud. Insider fraud occurs when an employee abuses their position to commit fraud. Insider fraud can include embezzlement, ML, and other forms of financial crimes. 4. Third-party risks. Institutions often work with third-party service providers, such as credit reporting agencies, loan brokers, and other intermediaries. Moreover, looking at terrorism financing risks in institutions. TF is the process of providing financial or other forms of support to terrorist groups. Institutions can be vulnerable to TF risks if they fail to identify the true source of funds or the intended use of the loan. Nature or sources of terrorism financing funds. The characteristics of TF can make it difficult to detect or identify. The methods used to monitor ML can also be used for TF, as the movement of TF funds often relies on similar methods, control vulnerabilities or shortcomings, used for ML. Funds that are used in TF may be derived from either criminal activity or may be from legitimate sources, and the nature of the funding sources may vary according to the type of terrorist organization. Lastly, TF processes are considered to typically involve the following three stages being: 1. Raising funds. Through donations, legitimate wages, selling items, criminal activity. 2. Transferring funds. To a terrorist network, to a neighboring country for later pickup, to an organizational hub or cell. 3. Using funds, to purchase weapons or bomb-making equipment, for logistics, for compensation to families, for covering living expenses etc. We have come to the end of the video on risk assessments. For more information, visit the FIC website at www.fic.na or contact +26 46 128 35287, email helpdesk@fic.na.